All right, let's talk Starz. Today we're digging into their pretty rough Q2 2025 earnings call. This was a classic case of a company telling one story and Wall Street hearing something completely different. So let's break down exactly what happened. Right off the bat, you can see the market's reaction was not great. The stock got hammered, dropping 18% in just a few days. Now, that's not just a little pullback, that's the market sending a really strong signal that it was not happy. So what on earth spooked investors so badly?
Well, here's your answer. It was a massive miss, plain and simple. Wall Street was braced for a loss of about 38 cents a share. Instead, Starz posted a loss of $2.54, and revenue came in light, too. You know, when you miss the mark by that much, people are going to run for the exits.
So to really get why they missed, you gotta look at the content. The whole quarter was basically a bet on two of their big franchises, and, well, they turned out to be two completely different stories.
And this is where it gets really interesting. On one hand, they had a monster hit. The Outlander prequel, Blood of My Blood, was a home run. We're talking the third best premiere for new subscribers in the company's entire history. But then you have the flip side, BMF. It's an established hit, but this new season just didn't bring in the new eyeballs they were banking on. It seriously underperformed.
And here's the bottom line, the number that really hurts. Because BMF stumbled, the company lost over 500,000 subscribers in North America in one quarter. In this business, subscriber count is king, and a number like that is a huge, flashing red light for Wall Street.
And to their credit, management owned it. CEO Jeffrey Hirsch basically said, look, BMF just didn't hit the numbers we expected. It didn't bring in the volume of new people needed to make the quarter work.
Okay, so a quarter like that raises the obvious question. What are you going to do about it? So let's look at management's game plan to turn this ship around.
Their strategy really comes down to three main things. First, they're getting serious about costs, planning to slash what they spend on content down to around $600 to $650 million. Second, they're going to lean hard into what works, their big franchises. Why? Because they keep over 85% of their audience, which is way, way better than average. And third, they want to own more of their own stuff, like the new show Fightland, to have more control.
And they're not just talking a big game, they've put some hard numbers out there. They're aiming for about $200 million in adjusted operating income by the end of this year, turning 70% of that into free cash flow next year, and hitting a really ambitious 20% EBITDA margin by 2028. It's a clear roadmap.
But that brings us back to the big question. If the plan is so clear, why did the stock get crushed? And this is the core issue with Starz right now. There's this huge gap between management's long-term plan and what the market is worried about today.
I mean, you've got two totally different narratives playing out. Management is saying, hey, be patient, we're building for long-term cash flow, our franchises are strong. But the market is saying, yeah, but what about right now? You just had a terrible earnings miss, you're losing subscribers, and you've got a lot of debt.
And analysts, like the team over at Morgan Stanley, have really zeroed in on these worries. They're pointing to the pressure on revenue, that high debt load, and just general concerns about the company's cash situation. These are the kinds of fundamental problems that a long-term plan doesn't fix overnight. And here's the number that keeps coming up, a net debt to EBITDA ratio of 3.2 times. That's pretty high. It's the kind of number that makes investors really nervous, especially when the business itself seems to be shrinking.
So, that's the whole picture. A really tough quarter, a credible turnaround plan, and a very skeptical market. Now, let's put it all together and figure out where we think this is all headed.
It really all boils down to this one question, doesn't it? When you weigh all the risks against the potential reward of this turnaround, what's our call on the stock?
Okay, here's our take. We're rating Starz as market perform. We actually think subscriber numbers will bounce back a little in Q3, mostly because that Outlander show is so strong. But we expect the stock to just kind of tread water. The market is in full show-me mode. It wants to see proof that management can actually hit those cost-cutting and cash flow goals. Until then, the biggest risks are still that high debt and whether they can actually execute the plan. It's just hard to see the stock taking off until there's solid proof in the numbers.
And of course, just a final reminder that this analysis is not financial advice. Thanks for watching.